Good morning and welcome to the India Capital Growth Fund Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Lucy Draper. Good morning.
Good morning, and thank you all for joining us this morning. My name is Lucy Draper, and I look after the investment trust managed by River Global. I'm pleased to be joined today by Elizabeth Scott, Chair of India Capital Growth Fund, and Gaurav Narain, the fund's investment advisor. We'll begin this morning's session with an overview from Elizabeth of the proposed changes ahead of the EGM on March 25th. Gaurav will then provide an update on the portfolio and current market positioning. Please feel free to submit questions at any point, and we'll make sure there is plenty of time for Q&A at the end, covering both the portfolio and the proposed changes. Over to you, Elizabeth.
Thank you very much, Lucy, and I'd like to add my voice to Lucy's welcome to you all today, particularly given the very turbulent markets that seem to be surrounding us at present. And I know that a lot of wealth management companies and fund managers are holding webinars and information sessions, so we're really grateful that you've decided to spend some time listening to us today. So thank you very much indeed. As Lucy mentioned, we'll have an AGM on Wednesday the 25th, an EGM, an extraordinary general meeting, on Wednesday the 25th of March. And we really would appreciate it if you would vote your shares at that meeting. And just to warn you that forms of proxy and indeed electronic votes should be with the registrar by Monday the 23rd of March. Now, there are two key elements to the special resolution that we're asking you to vote on. The first is the introduction of a 5-year conditional performance-related tender, which will replace the existing biennial redemption facility. The tender will be for up to 25% of the company's issued share capital at the time, and it'll be triggered if the investment performance of the trust falls short of the new benchmark. And you'll see on the charts, you'll see on the slides, and you will have read in the circular information about the new benchmark, which we believe more appropriately aligns to the types of investment that Gaurav and his team are making. We also intend to introduce an enhanced dividend, which will be paid semi-annually. And we expect that it will start off at approximately 2% of the net asset value of the company. So that's 2% of the net asset value of the company to be paid each year in 2 separate tranches. And that first interim dividend will be announced at the first half year results in later on this year. So why are we doing this? Well, we're taking advantage of the structural tools available to us as an investment trust, and we believe that these changes are very much in the interests of shareholders, and that they'll allow us, firstly, to optimize shareholder returns, and that they will help us to broaden investor appeal, and that they will, and perhaps this is most important, that they'll allow the investment manager greater flexibility to capitalize on the opportunities that we all believe exist in the Indian market. And I think it's very important to stress that there isn't going to be a change to the investment process, to the investment strategy, or to the investment team. I know you'll all have questions, and we'll get to those at the end of the presentation. But now I'd like to hand over to Gaurav to tell you a little bit about what's going on in the Indian market at present. Thank you.
Thank you, Elizabeth. I'll just give you a brief overview of really what's happening in the Indian equity markets, on the economy, and our portfolio as well. And just by way of introduction, I've been managing the India Capital Growth Fund for over a decade now, and I'm based out of Mumbai in India. So, really, on a broad, on the economy itself, the broad story about India is about sustainable growth. Over the last decade itself, India has been one of the fastest growing economies and is today at about 4 trillion. But even if you take the IMF's forecast over the next 5 years by 2030, it's actually expected to grow at a nominal rate of almost 10% per annum. But if you look at the government itself, it's a lot more ambitious. Actually, the government has set itself a target of being a $30 trillion economy by 2047. And the logic is that the 2047 is the 100th year of independence, and they actually want it to be a developed economy by that period. Now, this is actually not all just wishful thinking, because what the government is really doing is every ministry is working on this $30 trillion target and working backwards in what needs to be done to achieve that number. So in terms of not just the physical infrastructure, the social infrastructure, really everything is working around that strategy. But having said that, if you really go down more towards the ground level, I would say there's a fair amount of confidence within corporates and normal Indians that possibly we're on the right track. And I would say there are two factors which are determining this. The first is, on the investment side, I think the policy environment has become fairly favorable. Over the last 5-7 years, the government has done a lot to make it very investor friendly. And two things have happened. The first is the government itself has really upped its budgets on infrastructure. And I would say between the central and the state governments, today the infrastructure spending is going at almost $225 billion per annum. And if you see the last decade, almost every infrastructure has almost doubled. But the trend goes on, and I think this is now the base, and the focus keeps shifting. Earlier it was on road network, now it's on rail, it's the power sector, and the future is really moving towards more on the newer age data centers, etc. But it's not just the government side of it. A lot has been done on the policy environment level to encourage the private sector in terms of investments, making it easier to set up businesses, etc. And here too, we are actually seeing a lot of commitments. And today, if you see the sort of projects which have already been announced or under implementation, you're actually talking about almost $100 billion per annum coming in. This is almost 2x of what it was averaging over the last 5 years. I think the second leg of the story is really that India is a very large market by itself. It's not just the most populated country, but it's a very young population, median age of just about 28 years. 65% of the population is less than 35 years. And you're already seeing a very large market. In most segments, take cars, you'd be surprised that India is already the third largest market with over 4 million cars sold a year. But if you really look at it, car ownership per 1,000 users, it stands at about 34. China somewhere about 200 plus users per cars per 1,000 people, and in the US it's somewhere around 800. So what you're going to see is just not just volume growth, but it's also going to be a lot more value addition growth for premium products. So my sense is, what you're actually to really say is that India is really getting into an investment and consumption-led growth. And that's really where the confidence lies that possibly we should be able to sustain a high GDP growth for several years to come. The third leg is really on the macros itself. And here I would say the health of the economy is very sound. At the government level, everything from the fiscal is coming down, your forex reserves at all-time highs, inflation is at much below the central bank's own targets. At the corporate level, if you see leverage of the corporate sector is at historical lows, profitability is close to historical highs, even the banking system, asset quality is very stable, the banks are well capitalized. So I would say that structurally, the economy is in a very sound footing. So really, that's one side of it. But if you really look at the markets, Now, India over a 5-year period has actually done quite well. And if you see the small and mid cap segment of the market in these 5 years, they've been amongst the best performing market. The top 50 stocks has been slightly lower end, but I would say overall the economy and the markets have done well. And this is despite the last year. I think the last year India has been among the biggest underperformers amongst emerging markets. In fact, the level of underperformance at over 20% to emerging markets has been unprecedented. So why has this happened? I would really put two factors behind this. The first is valuations, that India had become very expensive. And what I've shown you here is both on the relative and absolute level. The chart on the left gives you the relative performance. This is the India's premium over the MSCI Emerging Market Index. And historically, India has always traded at a premium of about 60 to 70%. But last year, this actually shot up to almost 120%. And the reason was that India did well and the rest of the emerging markets was really floundering. That has actually corrected. And if you can see the chart, I think since September, the markets have really been underperforming. And today that premium is actually slightly below historical levels. If you see the chart on the right, this is the absolute valuations, which is still at the higher end. In fact, if you go back about a year, this number today, what is a 20-time forward multiple, was closer to 23 times, closest to the US. So absolute valuations historically has been closer to the 17, 18 multiples. And today I would say it's still slightly higher. But really what triggered the underperformance is the second factor, that since COVID, the earnings had been actually compounding at almost 20% per annum. But last year, for the first time, we actually saw a slowdown in earnings growth. In fact, it came down to low single digits. Now, when you have very high valuation and your earnings you had 3 consecutive quarters of disappointing earnings, you saw that big, flood of money out of India. Now, what caused this? I would attribute it to 2-3 factors. I think the first was that we did have elections in May 24. And typically when elections happen, you lose almost 6 months in terms of the government spending, etc. So your infrastructure spending, which was really driving a lot of the growth, actually came off. At the same time, I would say a bit of self-inflicting wounds, because the central bank, being very concerned of credit growth in the system being too high at about 14-15%, actually put a lot of curbs on liquidity in the system. So it really brought to bring down the credit growth. And I think the third factor was geopolitics, and largely India being slapped with a 50% tariff. Now, this caught the country by surprise, because everyone thought India would be the first one to negotiate a deal with Trump. And it was only a month back that we finally got that deal. But at a period where a lot of uncertainty, because for almost a year, you were really among the highest tariffed countries. So these were the real factor. But what it really resulted was that you've seen a flood of money going out of India. And the chart on the left is showing you the flows into the domestic equity markets in each of the last few years. The gray bar being what foreigner investors have been doing. And if you see, last year you saw almost $19 billion move out of India. But if you take a longer term view, foreigners have actually, over the last 5 years, not invested at all in India. The net flows have been a negative $12 billion. In contrast, the markets are being purely driven by domestic investors, which in this 5-year period has seen, the mutual funds have seen almost $235 billion come in. The result is that the ownership of foreigners in the Indian market is at record lows. It's just at about 16%. And when you speak with any foreign investor, you'll find that most are underweight on India. So where are we now? I would say a lot has happened in the last year to get that growth kicking back. And it really started with the government once it came back to power in the budget. The first budget, they slashed income tax rates to get consumption up. They continued with the infrastructure growth momentum. The central bank, which had tightened liquidity, unwound all the liquidity tightening measures, and has also since started interest rate cut cycles. In fact, rates have come down by over 125 basis points since then. In September, a very major reform happened in the indirect taxes, where the tax rates were slashed across the board. And from 4 tax slabs, it really come down to 2 slabs. And that's actually, again, kick-started a lot of growth, especially in the consumer discretionary space. And finally, I think the US tariff issue really got the government to try and negotiate a lot of other trade deals, and they accelerated a lot of these. And 5 FTAs have been signed in the last year, which included the EU, the UK, New Zealand. But more importantly, last month they've also signed up with the US, so the duties have actually come down. So that's really brought a lot of the uncertainty factors come down, and we're already seeing the results of all these measures. I think the last quarter, again, you've seen growth get back into the high double-digit figures. I think it was closer to 20% earnings growth, with both the top line and EBITDA also growing in double digits. So I would say growth is back, and by all estimates, you're seeing the next 2 years, again, growth for the markets, again, being closer to anywhere between 16 to 18%. So I think that aspect is really addressed. So what I'd say on the markets today is that the earnings growth is really back. Valuations have corrected definitely on the relative side, though on absolute valuations, they still seem at the higher end of historical averages. So really coming to the third part, which is really on the fund itself and what we are doing. So those who are not too familiar with the fund, ICGF is actually a very uniquely positioned fund. It's possibly the only fund which really plays the mid and small cap segment of the market. In fact, over 70% of our portfolio is small caps. And by small caps, the regulator definition in India is any stock which is not the top 250 stocks by market cap in the country. The other factor about the fund is that it's had a long track record. The fund was set up in 2005, and the investment team has been very stable. The three of us who've been really running the fund have been managing it since 2011, and we have built that track record over this period. On the investment side, we really are based in India, and we try and utilize that by building a fairly bottom-up stock portfolio. So we run a concentrated portfolio between 30 to 35 stocks. And as you can see, almost 90% has been off benchmark. But what we've done is we've built in very strong investment processes. And the idea behind this is so that we don't make mistakes. And why I say that is because in a number of companies, we may be the first foreign investor. We've taken large stakes in companies owning almost 5 to 6% in some of these small cap companies. So we've created a lot of processes to avert mistakes. But broadly, the process, if you see our investment portfolio, there is definitely a strong growth bias, because the sector of the market we see a lot of growth, but a very strong quality bias as well. And the other aspect of our investment style is that whatever we buy with the intent that we want to hold it for 3 to 5 years. Trading in the portfolio is low, with the portfolio turnover being just about 10 to 12%. Coming to our portfolio itself, I've tried bucketing it into the sort of themes we play. But what I'd really like to highlight is whatever we try and own in the portfolio, each of the stocks, I would say, are either leaders in their segments, or have a niche which gives it a moat. So, for example, digitization was a big theme. A company like Apple, you may not have heard of it, but it's the largest ad tech company in the country, very profitable. CarTrade is the largest online trading platform, 80 million unique visitors per month, huge operating leverage. They spend nothing on advertising because it's all by word of mouth. A big theme we have is the supply chain rebalancing, which is happening out of China. And we are playing it across electronic manufacturing companies, chemical companies, pharma companies, auto ancillaries. Here to say, take a company like Dixon. It's something like the Foxconn of India. Is the largest EMS manufacturer in India. All Android phones are manufactured by them. Consumption, a big theme. Again, this has been our largest part of our portfolio, but a lot of shifts happening largely because we find that, we have now a very aspirational consumer. It's moving from pure FMCG growth towards more discretionary growth. So we have companies like VIP, the largest luggage manufacturer, Kajaria, the largest tiles manufacturer. And then there's the domestic capex theme, where companies like Skipper is the largest manufacturer of transmission towers and the lowest cost producer globally. This is a big theme on the power sector infrastructure spend that's happening. Titagar, likewise, is the largest manufacturer of railway wagons for both freight trains and passenger trains. And in India, you're seeing a massive growth in metro networks with almost 23 to 24 cities already having operational networks. So I would say that's really the core theme. But what we try and do is we do not enter into, I would say, businesses which are very global. For example, we never own a pure global commodity business. We won't own businesses which are very complex, have multiple businesses which are really hard to understand. So I would say we are very focused in what we own and where we get predictability over the next 2 to 3 years growth. Coming to the portfolio valuations, what you see is, the table on top, the portfolio has a very high growth, which we were talking about. The average today, you're seeing a growth of almost 35 and 29% over the next 2 years. But if you take out 5, 6 abnormal ones, we're still looking at a 20% plus growth over the next 2 years. Historically, our portfolio has averaged a growth of about 16 to 18%. So we are actually seeing a higher growth phase on the back of a slightly lower base because of the weak growth last year. But the valuations, I would still say on the higher end, we are anywhere between 22 to 24 multiples, and on FY27, which I would say is high. So it's simply because of the high growth that we see. But just coming to the portfolio, we've also put the weights of our top 10 stocks. And what you'll notice is, almost 8 of these 10 we've owned for over 5 years, which really reflects what we do in the portfolio. Now, the top 10 weights keep changing because, if the company is a strong business with sustainable, predictable growth, we play around a lot with our weights rather than exiting the stock if we find that it's a sustainable long-term growth story. Just on the performance, our 5-year performance has been fairly strong. We've done about an 80% absolute return in sterling terms. I think the last 1 year has been weak and we've seen a negative return. But I would attribute a lot of this to the rupee depreciation versus the sterling. I think in absolute terms, we are about flat. But my sense is, what we really try and do on the portfolio is if you're able to deliver at 18 to 18 odd percent earnings growth, then that itself should drive your overall longer term absolute returns. And we're very focused on trying to ensure earnings growth deliver the absolute returns for the portfolio. To really summarize, I would really say that, India is back on the growth trajectory. I think the weakness we've seen is more or less addressed with a lot of policy measures. On valuations, at least the relative valuations have normalized, though absolute, I would still say slightly on the higher end. But the fact is, India is very under-owned today by investors, and it's a matter of time we may possibly see them come back. And on the portfolio itself, I think it's very well balanced. There is high growth, but clearly valuations are still, I would say, at a slightly richer end. But the sort of time correction we've seen in the market, today we are finding a lot of very interesting investment opportunities, which we weren't seeing about 6 months back. So really, I'll end there and leave with one last slide, and my favorite slide. And this is that, it's really showing how India has performed over the last 2 decades. And it's actually been amongst the best performing markets over long-term periods. And the simple reason is that this period has also seen India's nominal GDP growth itself growing at about 10%. So the markets are actually just reflecting this growth. So I'll really end there and take it back to Lucy for any closing comments.
Thank you. Gaurav. So I think we have not too many questions today. Please do submit if there are more. Carrying on with the investment theme, we have a couple of questions, one around the benchmark. So given that IGC still holds a greater small cap bias than the new benchmark, how much tracking error do we expect with the new benchmark?
Fact is, what we tried doing was getting a benchmark which closest reflected our portfolio. And, our earlier benchmark, the BSE mid cap, became virtually an all mid cap portfolio. There was no small cap. And we thought using an MSCI index, which is recognized by everyone and is possibly the closest, would best reflect our performance. I would still feel the tracking error will be high, and this reason is simply because, and I'll possibly show you the, I'll put a chart. The simple reason is that, we run a concentrated portfolio. Today it's 34 stocks. And if you see the MSCI index has 500 plus stocks. And our earlier index also had 140, 145 stocks. Our whole idea is that, over the longer term, it evens out, but in the short term, there is definitely volatility because of the concentrated nature of our portfolio, and the fact that it's small caps, so small caps typically tend to be volatile. But to address this, whole idea has always been to buy high quality businesses where we do get predictable earnings growth. So over the longer term, it's really we are really focusing that we should be able to deliver that absolute return over a period of time.
Thank you. And just to continue on the portfolio, the NAV per share for the portfolio has not really grown since 2023. Please, can you give your thoughts as to why there has been no overall growth in NAV share over recent years?
Yeah, I think it's quite an unusual situation we've seen. It's not that the portfolio has not delivered. In fact, over these 2 years, what we've seen is the absolute return, I think since September of 23, has actually been about 19%. And when I'm saying absolute return, this is in INR terms. So that's the return the INR NAV has delivered. But we've seen a very unique situation where the pound has appreciated versus the INR by almost 20%, which is why you're seeing a flat NAV growth. And I'm quite perplexed at why this has happened. In fact, the dollar has appreciated by about 10% versus the rupee in the same period, and the pound has about 20%. Now, what we've seen historically, and if you take a 10, 15, or 20-year time period, the Indian rupee has typically depreciated by about 2 to 3% per annum. Though this depreciation happens in one small 4-5 month period, you have a big depreciation, and then it flattens out. And my sense is, even if I now look at after this 20% appreciation which the sterling has happened over a 10-year period, this appreciation is about 35%, both for the sterling and the dollar. So that really fits in again with the 2 to 3% we've seen historically. So it's an unusual period, and I'm quite perplexed at why the currency has depreciated so much. But I'm fairly confident that given that India is sitting on $700 billion plus of reserves, and structurally the current account is so much stronger, that it should balance out going forward. So I think the only reason possibly the currency is depreciated is because we've seen a lot of flow out of money, not just from the the listed equity shares, but from the unlisted side as well. And I mentioned that we've lost about $19 billion of FII flows last year. But an interesting trend you've seen is a lot of unlisted companies which went public in the last year and a half because they found Indian valuations very, very good and attractive to take money out. And two such interesting cases is LG Electronics, the Korean entity, which is the largest consumer durable manufacturer in India. They went public last year. Hyundai, which was the second largest automobile company, and again 100% arm, which has been in India since the early 1990s, also took the company public, and they've really repatriated their money because they need it overseas. Even some listed companies like Whirlpool of India has reduced their stake from 74% to, I think, 40%, and repatriated that money because they were heavily levered in the home market. So a lot of, private equity, India has actually become a very liquid market, both in the public side and the private side. So given that, valuations were high and it was so liquid, I think a lot of money has moved out, which possibly has led to this currency coming off. But structurally, I think the economy is, as I mentioned earlier, is very sound in terms of the macros we have.
Thank you, Gaurav. And one for you, Elizabeth. What is the DRIP and how would it work?
Thanks, Lucy. The DRIP is obviously, is the dividend reinvestment programme. We will be sending out full details of how that will work at the point when we announce our first interim dividend at the end of the first half of 2026. But the expectation is that you as a shareholder will be able to let the registrar know that you wish to reinvest the dividends into the shares of the company rather than taking the dividend into your bank account. So that's the principle behind it, and the full details will be sent to all shareholders at the time, or slightly before the announcement is made.
Thank you, Elizabeth. And some more questions on the portfolio for you, Gaurav. With only 34 holdings, what is the contribution of the top 5 stocks to annual volatility, and how often does turnover occur within the 34 stock portfolio?
Yeah, so I think there is a fair amount of volatility. And to give you an example, say I think today RBL, which may be, if you look at, you'll find a lot of banks which are in the top holdings. And that's simply because last year the banks did exceptionally well. And RBL itself, the top has gone up almost 100% in this period. But what we've been doing is, we've been trimming a lot of weights. In RBL's case, we've not trimmed, but the other bank, Federal Bank, IDFC First, City Union Bank, we've cut weights. If you go back, I think a few months back, a multi-commodity exchange was a 5.5% weight, which is today at about 4.5% because we've taken that 1% off. So what we really do is we look at each stock individually in terms of its current valuations, what is the growth, what is the sort of price we see 2 to 3 years down. And based on that, we play around with the weights. So a lot of shuffling happens, I would say, within the top 20 stocks. Because typically what you'll find is stocks which do exceptionally well, the weight also increase and the risk reward doesn't become as favorable. Typically what we'll do is, unless we feel something structurally wrong or something's changed in the business which warrants an exit from the company, otherwise we typically play with the weights. If the risk reward is not very favorable, we'll take a higher weight off the portfolio. And the reasons is simply that, a lot of these businesses which we bought, I would call our structural compounding stories. And we want to play that compounding theme. Because if you sell one of these, finding a better alternative is not so easy. And simply because, as I mentioned earlier throughout this presentation, that, valuations have been high. So there are a lot of great businesses we'd want to own, but we'd also want to own it at the right valuation, so we don't see much of a downside once we get in. So we are really playing with the weights, and there is a fair amount of churn on the weights, I would say.
Thank you. And one final question. If the current war in Iran continues, how might this impact the fund and influence your decisions?
I think that's a very difficult one, because there is, I would say, no direct impact on any of our portfolio companies, because we are really not, none of them are very oil sensitive in any direct way, or have the Middle East as very large markets. I think there is a big indirect impact, because what we saw in the COVID and post-COVID days, that you see the big impact we typically see is from inflation, and I would say a lot on the freight side. freight and packaging. Because, the fact is, whatever we do with the Western world, and that's where a bulk of our trade is, has to go through the Red Sea. And, the longer this happens, you have the ships pile up, then you'll have again the whole situation of containers being at the wrong place, and the freight cost just shoots up. And then there is the indirect impact of oil prices, which again really flows into the entire packaging, polymer prices, etc. So the hit really happens, I would say, on the margin front going forward, and then there will be delays in shipments, etc. On direct impact, I would say it is negligible, really. But I think the longer this plays out, the more the uncertainty factor, and you will have deferment of sales, etc. So that could be a issue. But looking back, I'm really trying to see what do I change in the portfolio, how do I de-risk, and I really can't find any specific stock which I say, look, this is where it is. What we're actually seeing is a broad-based fall. In fact, some stocks within our portfolio, in fact, today we've actually been buyers in the market because certain stocks have come to a level where for us, it's, from a 3-year perspective, it's some which we'd actually sold off and reduced our weighting. So we said, look, this is a great opportunity to get that back in. So I would say my mindset today is more on being a buyer in some of our existing portfolio. But clearly, those are the businesses which we see the least impacted are pure domestic plays. And you feel that, over a 3-year period, you're getting that 30% minimum upside from these levels.
That's great. Thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which is particularly important to the company, Elizabeth, could I please just ask you for a few closing comments?
Well, I'd just like to say thank you very much to all of you that have attended the webinar. We're really grateful to you for listening and watching today. Thanks to Gaurav, as always, an excellent presentation. I've come away with, particularly at the moment, thinking about the strength of the underlying strengths of the Indian economy and the opportunities from growth and quality companies, small and mid-cap companies in India. And hopefully the current market turbulence, as Gaurav's just been saying, provides something of a buying opportunity for those that are interested in doing so. Just a final word on the proposals. We very much hope that the proposals that we've put forward are attractive to you as shareholders. We, the board, will be voting our shares in favour of those proposals at the extraordinary general meeting on the 25th of March. And we would be very grateful if those of you that hold shares would also vote your shares in favour of the proposals, because we think that they will benefit the long-term position of India Capital Growth Fund. So many thanks for joining us today.
That's great. Thank you for updating investors today. Can I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team, we'd like to thank you for attending today's presentation, and good afternoon to you all.